Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Call me. President Trump presses China to make a tariff offer to calm trade tensions, while at the same time threatening to add duties on critical mineral imports. Chip wars. The U.S. bans Nvidia from selling its H20 chip to China. The company warns the battle with Beijing will cost it billions of dollars. And early momentum. China's economy expanded at a faster pace than expected in the first quarter of 2025, but that was before the trade war kicked into gear. Well, it's just gone 8 a.m. across the Emirates. I'm Jumana Bersachi in Dubai. I'll tell you what, the markets attempted to stabilize over the last couple of sessions and attempted de-escalation, talks of potential deals being formed between the U.S. and key trading partners, but everything has turned south once again in the last 24 hours, and you may be asking why. Well, because we may be moving from a regime of the U.S. just applying levies and tariff controls to now thinking about export controls. And that was the big news that hit the tech sector yesterday, with Nvidia saying that the ban on the export of their H20 chips to China will cost them $5.5 billion. So on the back of that, you are seeing these tech names in the U.S. and in Asia take a bit of a hit today. And that is why, as you can see behind me, once again, it is a sea of red. And then you also have the likes of European trade negotiators going to D.C. to try to formulate a deal with the U.S. and coming back empty-handed saying, we don't know what the U.S. wants in terms of deal and what they're looking for. And so, yet again, we're seeing sentiment turn south. And we've got S&P futures down 0.9%, NASDAQ down 1.5%. Keep a close eye on where Nvidia opens up today. And after hours, it traded as low as 6% once that news came out. And we've got European futures also trading south, down about 0.75%. And then take a look at the Hang Seng today, down 2.5%, despite the fact that China Q1 GDP data came in better than expectations, retail sales numbers better than expectations. Investors are looking ahead because in the coming quarters, you are going to see an impact from this trade war, in addition to the fact that some of those chip stocks and those tech names have been coming under selling pressure this morning as well. Switching over, keeping a close eye still on what's been happening in the U.S. Treasury market. Here, the theme is actually one of stabilization. We've moved a lot lower since the scare that we had last week. 4.32 is where we're at, so trading sideways today. And in terms of what else to watch out for, remember, in the U.S., we get retail sales numbers later this afternoon, and then the Fed Chair Jerome Powell will be speaking as well. So any clues on monetary policy will be key for direction, but some stabilization coming through there. The USD has resumed its downward trend. Once again, people are selling the greenback. Today, down 0.3%. Where is money going into? Well, the safe havens. You've got yen, you've got the Swiss franc, but then also the euro doing quite well. And all eyes on that ECB meeting tomorrow and the tone that they strike there, the 25 basis point rate cut priced in. Brent just sitting below $65 now, so trading sideways the last 24 hours, but still close to 4-year lows. And then gold, once again, all-time record high. Another safe haven performing very well, up 1.6% today, up more than 20% year to date. So gold continues to glitter, as they say. Well, President Trump has called on China to reach out to him to start negotiations on resolving their escalating trade fight. The White House press secretary, Caroline Leavitt, read a statement from the president challenging Beijing to pick up the phone.
I do have an additional statement that he just shared with me in the Oval Office. The ball is in China's court. China needs to make a deal with us. We don't have to make a deal with them. There's no difference between China and any other country, except they are much larger. And China wants what we have, what every country wants, what we have, the American consumer. Or to put it another way, they need our money.
All right, for more, let's bring in Bloomberg's Bill Ferries. Bill, I don't know if you heard me at the top of the show, but it feels as though once again in the last 24 hours, things have taken a turn for the worse, particularly between the U.S. and China with these new export curbs on Nvidia chips. And then that statement that the press secretary just read out now suggesting that President Trump would like President Xi to give him a call. China seems to be playing hardball.
Yeah, it seems like neither side wants to blink first here. Trump imposed, of course, those huge 145% tariffs on Chinese imports. China has retaliated with 125% tariffs. And now the ground is shifting to more of a sector-by-sector approach by the Trump administration in the latest move announcing or Nvidia announcing that their H20 chips, which were actually specifically designed to kind of get around some of the really tight U.S. restrictions and are kind of a downgraded chip, that those are going to require a license and likely won't be allowed for export into China. And then, of course, you have a new investigation into critical minerals, including rare earth imports, which largely, in the United States case, which largely come from China. So it continues to be this tit for tat, this ramping up of the dispute between the two countries, and neither side really willing to pick up the phone at this point.
Yeah, what is the potential for deals with other trading partners around the world? I did think it was interesting that the EU trade representative went all the way to DC to discuss the potential for a deal, but essentially walked away empty-handed because they said they would like to see more information from the US's side. Is market optimism around getting these deals done in the next 90 days perhaps misplaced at this point?
Well, the Trump administration says that they're still looking to make, depending on who you talk to, 10 great deals or even 90 deals in 90 days. As Howard Lutnick said earlier this week. But the terms of those deals are very vague, at least that's the perception that a lot of the governments outside of the U.S. have. They're sending delegations in. They want to talk. But the U.S. requirements seem to be shifting for each country. In some cases, there's a matter of lowering tariffs or discussing non-tariff barriers. In some cases, the U.S. seems to want investment in certain projects, such as energy projects. So I think the big thing for a lot of governments is they want to make sure that any deal they get is solid, that it's final, that when you reach an agreement, President Trump isn't going to change his mind a day, a week, or a month later. And that's not something I think the White House has shown it can give with a lot of certainty so far.
Yeah, Bloomberg's Bill Ferries, thank you so much. Let's pick up the conversation with Deepak Mehra, Chief Economist at Commercial Bank of Dubai. What do you think the end game is with tariffs? The market reacted positively to the announcement that there's going to be a 90-day pause, the potential for some deal-making going on. Where do you think this all leads us?
I think let's take a step back and see where U.S. and China stand. So U.S. imports $3.5 trillion worth of goods, which is bigger than the GDP of Germany or France or UK. So it's a massive market, consumer market. So China can't ignore that. The rest of the world cannot ignore that. They can't find substitute buyers if they have to move away from the U.S.
Yeah.
At the same time, China provides $440 billion of goods to the U.S. So even U.S. can't find substitute manufacturers to Chinese goods.
Well, here's the thing. It's interesting you mentioned that. I read a comment by Adam Posen the other day in the FT, and he was saying that the fact that China sells so much to the U.S. actually gives them leverage because American consumers want to buy those Chinese goods. And we're talking about toys and electronics and Christmas gifts and air conditioning units and all of that. But these are essential goods for the American consumer. And therefore, because China know that, yes, they have the economic linkage, but then they also have some political leverage.
Absolutely. So even the U.S. has that leverage because they consume so much. So the arguments go both ways, and that is why it is at a logjam. But my belief is that these are hardball tactics to get a few outcomes which may not be trade-related. So Trump may be looking at certain other outcomes from China, decoupling it possibly from technology perspective, so that because that's national security, and then getting other concessions. My belief is that the end game, given how complex this is, and given manufacturing can't move back to the U.S., which moved out for 25 years, it'll take a couple of decades to come back. I believe the end game is that there will be a sort of a phenomenal deal which will come out somewhere from the woodworks, and which will be then acceptable to both. And I'm sure in the back end, there are negotiations happening which are not in the public.
It's funny, actually, because you just reminded me of his first term. And if you remember, they did actually come to a deal. There was a trade deal that was announced, and then China didn't commit to their side of the bargain, right?
Because COVID happened.
Because COVID happened, which was, I guess, a convenient excuse for them not to commit to some of the terms of the deal. But so that is interesting.
Yes.
Let me just ask you, though, about U.S. exceptionalism. Everyone's gone cold on this idea that U.S. is going to outperform the rest of the world. Do you think that that is valid?
U.S. exceptionalism may have taken a backseat, but it's not out. It may be on hold, but it's very much there. I mean, tell me, where do we have companies like Microsoft or Amazon? Where would you find cloud services? Where would you find search engines like Google? Can you start making all of these again? Or chips from Nvidia, or social media that Meta controls? There is nothing out there. Yeah. So innovation, technology, the depth of the markets, 60% of global market cap lies there. And it's not just because it happened there, it's because of the strength of the balance sheets, the cash those companies, large companies carry, the global dominance they have, the pricing power they have. We don't have those parallels either in Europe or in Japan or in the emerging markets. So yes, people will look at, traders will move around, but long-term money will look at opportunities when markets fall like the way they have. These are great value that has been uncovered.
So the long-term thesis is still there, but in
Absolutely.
the interim, given how much bumpiness and volatility there is, and many people are talking about the fact that the soft data has started to turn,
yes.
but we haven't seen it in the hard data yet. If the U.S. does fall into a recession, what does it do to some of those long-term theses that you just outlined?
So I think from an allocation perspective, we don't change that allocation. What we are seeing with our clients and in general here is that people are under-allocated to gold. So we need to look at long-term plays here. So for me, Europe is not a long-term play because rest of Europe is not like Germany. They can't expand fiscally, and possibly the markets have already run up quite a bit. Gold is under-allocated by investors, and that has a long way to go.
Is the positioning at extreme on gold? I mean, there's been so much money pouring into it. It's been the safe haven, the universal safe
yes.
haven for over the last 6 months. I would say we're sitting at an all-time record high. How much further can it run?
I think if you look at last 3 years, it was only central banks that were buying gold. The ETF AUMs were falling, which means the average institutional and individual investor was distracted by equity markets and the tech sector. Those AUMs have started rising, and that could be a long-term allocation strategy. And therefore, gold has a long way to run up from here. Yeah. And what we're suggesting is that allocation to gold in the portfolio is a must now. And therefore, this, for us, is a long-term theme, other than U.S. Tech sector, which remains very, very strong and has no parallels anywhere else. And therefore, value has emerged when you have sell-offs like this.
Yeah.
As every sell-off is an opportunity to start increasing your allocation.
Yeah.
For the long term, not for the short term.
So it's like a barbell approach to the portfolio, the tech and the gold.
Safe.
Yeah. Deepak, always good to chat to you. Thanks for coming on. Deepak Mehra, Chief Economist at Commercial Bank of Dubai. Well, coming up, French President Macron and Israeli Prime Minister Netanyahu spar over recognition of a Palestinian state. More details on that call next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Joanna Versace in Dubai. Israeli Prime Minister Benjamin Netanyahu has sparred with Emmanuel Macron over the French president's plan to recognize a Palestinian state and encourage other countries to do the same. During a phone call with the French leader, Netanyahu said a separate state would be a bastion of Iranian terrorism. Macron also pushed for a broad ceasefire and a resumption of humanitarian aid to Gaza. For more on this, we're joined by our managing editor for the Middle East and North Africa, Onur, and a lot actually to talk about in terms of developments in the region. You've got, obviously, the discussions going on around the Gaza ceasefire. I also want to bring up the Iranian discussions with you, but maybe let's just start with that call that took place yesterday between Netanyahu and Macron. Did we get anything out of it that would suggest a potential new or renewed ceasefire, release of hostages could be imminent?
It's true that that's what the French officials are focusing on. They say that they are trying to get humanitarian aid flowing into Gaza, possibly as part of a broad ceasefire deal that would also see Hamas release about half of the living hostages. That seems to be the focus for France right now. But as you mentioned, they've also been pushing for a Palestinian statehood. But we have seen since yesterday that French officials kind of took a step back, and now their renewed effort seems to be both for the ceasefire and a possible conference in June designed to basically normalize the relationship between Israel and some of the Arab neighbors, including Saudi Arabia. And there seems to be less focus now on an immediate demand for Palestinian statehood, as opposed to Macron's earlier statements.
Yeah, which is, of course, one of the criterion that Saudi Arabia are pushing for to go along with those normalization discussions.
That's correct.
Let's talk about the Iran file, because the conversations are going to be continuing, as we know, between the U.S. and Iran over the course of this weekend in Rome. But the Trump administration is trying to dial back a little bit from Steve Witkoff's comments, because Steve Witkoff suggested that they were going to be having discussions about no further enrichment as opposed to a full dismantlement of the nuclear program in Iran. What do we know about the setup into these talks this weekend?
As you said, Witkoff's earlier statements were almost a breakthrough in the way that the U.S. has so far approached this issue. It was also against what hardliners both in the U.S. and Israel have been pushing for, which is a full dismantling of Iran's nuclear program. What Envoy Witkoff said was that Iran could be allowed to enrich uranium until a certain purity that would only be enough for civilian use. Now, what we have seen yesterday is that both Witkoff himself and the State Department dialed back those comments, and now the focus again has been on whether or not Iran should be allowed to have a nuclear program in the first place. This is kind of a step back, or this can be a step back, as the two sides are preparing to go into a meeting later this weekend, as you said, possibly in Rome, but also possibly in Muscat. Even the fact that they haven't been able to announce where the meetings will take place is a sign that there is some behind the doors friction between the two sides.
Also, just to remind viewers that the Iranian side have said that it would be a red line for them. The discussion around the full dismantlement of the nuclear program is a non-starter as far as they're concerned. So it's interesting to see that the Trump administration, the State Department, and now bringing this up again.
Yeah.
So let's see what happens the next few days. Onur, thank you so much. Onur Ant, our managing editor for the Middle East and North Africa. And coming up, the UK and Germany pledge millions in aid to Sudan. We get the details of an international forum being hosted by Westminster to end the war next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jemana Versace in Dubai. The United Nations says attacks in Sudan's Darfur region this week have probably killed more than 400 civilians. The UK is hosting an international conference to discuss ways to end the two-year civil war in Sudan, with Britain and Germany pledging millions in aid.
And today I'm announcing a further £120 million worth of support. But the biggest obstacle is not a lack of funding or texts at the United Nations. It's a lack of political will. Very simply, we have got to persuade the warring parties to protect civilians, to let aid in and across the country, and to put peace first.
Bloomberg's chief Africa correspondent Jennifer Zabazaja joins us now. Jen, well, this war started 2 years ago. It's been going on for 2 years, has been devastating in terms of the humanitarian toll, the economic toll, political, of course. Is there any end in sight at all for the civil war that's been ravaging Sudan?
Right, Jemana. Well, the concern here amongst many experts and groups and aid workers is that this has really broadened out from a war between two factions, really the army within Sudan and also the paramilitary group, the Rapid Support Forces. And it's broadened out to include a lot of proxy players that are, you know, in what many people are saying, are accused of aiding in this continued fight. We've seen escalating violence. You were just mentioning there. We've seen violence violence just over the past few weeks and days that are, creating even more of a humanitarian disaster. And just taking a look at some of the numbers, I mean, 25 million people are facing a humanitarian crisis. The UN says at least more than 3 million people have fled from their homes. 12 million people have had to flee from their homes within the country and sleep elsewhere. And so the concern here is that humanitarian aid is not getting in, but also many of the fighters now and the armed groups look like they are cementing within these strongholds that they are in. We know that the RSF, which is the paramilitary group, still controls most of western Darfur and some other areas. And the army actually controls Khartoum. And so many people did see the army's ability to reclaim Khartoum as potentially an end in sight for this crisis. But it's not looking like that. And just hearing from international players about the role in which they could potentially play, it's looking even more bleak. It really needs to be not just the forces that are fighting on the ground there, but some of these other players that are accused of aiding some of the groups there.
Yeah. And Jen, we speak obviously about this conference that's taking place in Westminster, organized by the UK. One of the primary focuses is to get more humanitarian aid into Sudan. Why has it been so difficult to get the aid into the country to begin with?
Well, if we take again a look at what the UN has said, a lot of it has been bureaucratic discrepancies that we've seen. But also we've seen there's not just the two main armed groups that started fighting 2 years ago, but there's a number of other people who are on the ground who have been fighting. And so the escalation of this violence has become even more pronounced, again, blocking aid into the country. We did see this conference, though. It was co-hosted by the African Union. And as you mentioned in your intro, we did hear that there is going to be more financial assistance, at least pledged from the UK, the EU, and others. But we should also note that we've seen aid, financial aid rescinded, namely from the US and even the UK, which actually said that they were stepping back on providing aid more broadly and focusing then on their defense finances. And so really, it's been a combination of factors. And I think what's important to take a look at the summit that we saw yesterday, we didn't have any of the two warring sides that actually started this conflict 2 years ago invited. It was many of the major players who potentially can talk to some of the proxies who are accused of aiding and abetting in this war. But if we don't have the people who are, again, accused of potentially blocking aid and getting humanitarian assistance to many of the people on the ground, it's looking like this could potentially continue to be what the UN calls one of the worst humanitarian crises that we're seeing in the world right now.
Yeah. Jennifer, with all the details, thank you so much. Jennifer Zabazaja, Bloomberg's chief Africa correspondent in Johannesburg. And a look at equity futures. Things are turning south. The sentiment on trade war has turned a lot worse in the last 24 hours. We'll give you all of the details in just a few moments when we're back. But coming up, President Trump's tariffs could cloud sub-Saharan Africa's economies. We hear from Standard Chartered chief economist. Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Call me. President Trump presses China to make a tariff offer to calm trade tensions, while at the same time threatening to add duties on critical mineral imports. Chip wars. The U.S. bans Nvidia from selling its H20 chip to China, and the company warns the battle with Beijing will cost it billions of dollars. And early momentum. China's economy expanded at a faster pace than expected in the first quarter of 2025, but that was before the trade war kicked into gear. It's just gone 8:30 a.m. across the Emirates. I'm Joanna Versace in Dubai. Take a look at all these markets behind me. Lots of red on the screen today. We did have a couple of days of stabilization for Wall Street, some of these global markets ending up in the green, but things are looking sour today, and namely because of the new tariff news that has emerged and the fact that the Trump administration is moving their focus away from just imposing tariff and levies on Chinese goods to now thinking about export controls as well. And Nvidia very much in the eye of the storm there, saying that the fact that they can't export their H20 chips to China anymore is going to cost them about $5.5 billion. So you're seeing a notable impact on some of these tech names in the region. Chip stocks coming under selling pressure. Look at the Hang Seng today, trading 2.5% weaker. And this despite the fact that the China GDP numbers for the first quarter came in higher than expectations. The Chinese economy growing at 5.4% versus 5.2% expectations. Industrial production numbers, retail sales numbers also beating to the upside. But that wasn't enough to turn sentiment around because many people are saying, well, that's backward looking. If we think about what's going to happen in the months ahead, we are going to see a bigger economic hit from this trade war that's going on between China and the U.S. with no signs of that abating. Switching over, though, let me just take a look at some of the other cross-asset indicators that we follow. U.S. Treasuries obviously very much still in focus, but see some stabilization coming through. 10-year sitting at 4.33. All eyes on Fed Chair Jerome Powell's speech later today for clues about monetary policy. The USD continues to get sold into, so now down about 0.3%. So that theme of heavy dollar trading doesn't seem to be going away. Once more being sold into today on this risk-off session. And then Brent, we have stabilizing just below $65, 64.5 here, but still close to 4-year lows. Again, the demand outlook has been weighing heavily in addition to that OPEC Plus decision we covered extensively last week. And then gold, all-time record highs once more, getting close to 3,300 now. So this is where we are, 3,272, up 1.3% on the session. But Chinese President Xi Jinping is urging Malaysia to work with Beijing to protect supply chain stability as he visits the country on the second leg of his Southeast Asian tour. Xi is scheduled to meet today with the Prime Minister Anwar Ibrahim. So let's get out to Bloomberg's Avril Hong, who doesn't join us from the studio in Singapore. She's actually on location at Putrajaya in Malaysia. Avril, really good to have you on the show. Maybe just talk us through what is at stake for both of these leaders here, both Chinese President Xi Jinping and Anwar Ibrahim of Malaysia.
Yeah, there's a lot at stake, and it's a bit of a change of scenery for me coming to you live from Putrajaya, which is the administrative capital of Malaysia. Now, in terms of what's at stake for China, think about how it's coming at the time where it's trying to shore up domestic growth and supply chains at the same time. You think about this action plan that we're hearing Chinese authorities talking about today, and amid all this, note as well that for some of these Southeast Asian nations that were among the hardest hit from Trump's tariffs prior to the 90-day reprieve, what Xi is looking to do now, some think, is to convince leaders in this part of the world not to engage in trade deals or tariff-related deals with Washington that could potentially come at the expense of Beijing, and at the same time try to promote China as a more stable partner than the U.S. Now, for what's at stake for Malaysia, keep in mind that China has been, for the past 15 plus years, its biggest trading partner. So it has to sort of stay friendly with Beijing, a really fine balancing act, and at the same time engage in these negotiations with Washington. And indeed, in that friendliness, which is part of the reason why I'm here at Putrajaya, where the two leaders, Chinese President Xi Jinping and Prime Minister Anwar Ibrahim of Malaysia, are set to meet just behind me, and there's expectations of exchanges of MOUs, I should say, as well as remarks from the two leaders. There's really been a very warm welcome for the Chinese leader in this part of the world.
Yeah, Avril, really good setup there. Today we were talking a lot about some of the price action and the chip makers and the fact that Nvidia now in the eye of the storm with these export controls. And I just wonder, from the perspective of China and Malaysia, what specific sectors are they going to be focusing on in terms of enhancing those economic and trading ties?
Yeah, Jumana, I think those sectors are absolutely in the spotlight, commodities as well as chips, because you think about how for the likes of China, it's been halting exports of rare earths. And we're hearing how the US is announcing this probe into critical minerals. So rare earths are now figuring into the equation, certainly, for US-China rivalry. And that is something that Malaysia has a lot of, even though it still kind of depends on Chinese technology in order to process these rare earths. Now, when it comes to technology, Malaysia has strengths in data centers as well as lower-end semiconductors. So any indication that investments are intact or indeed potentially enhanced would be encouraging, Jumana.
Yeah, so interesting that rare earths are becoming such a big topic of conversation now as well, with the Trump administration also weighing potential curbs or extra tariffs on critical mineral imports too. So it's all very complicated. Bloomberg's April Hong in Putrajaya for us. Thank you so much. Now, President Trump's pause on his so-called reciprocal tariffs has provided welcome respite across sub-Saharan Africa, whose economies face some of the highest rates in the world. But worries persist, with little progress in Washington's talks with much bigger trading partners, such as the EU, and a concern that small African nations have few concessions to offer. Joining us now is Razia Khan, Standard Chartered Chief Economist and Research Head for Africa and the Middle East. Razia, it's really good to have you with us on the show. Maybe let me just start off by asking whether you saw this 90-day pause on the reciprocal tariffs as a welcome development for sub-Saharan African nations. Many were going to be subject to much higher tariff rates. But does this mean that they're out of the storm?
Well, not necessarily, just as you mentioned, Jumana. The concern here is 90 days even going to be enough time to negotiate any of this properly? What we do know is that the Trump administration is very likely to give that much more focus to the more important trading partners. So the likes of Japan, South Korea, Vietnam will feature quite significantly in these negotiations. Many African countries, by virtue of the fact that they do have small economies, some of them are reliant on exports to the US market, got hit with those higher reciprocal tariffs. And it remains to be seen whether there's going to be enough time to be able to negotiate anything. But the more important point is what kind of concessions could these countries possibly offer?
Yeah, exactly. What type of concessions can you offer, especially given if your starting point is that you're a low-income country, you're not going to have the purchasing power to buy the goods that the U.S. manufactures to begin with. So that's a big question mark. I do want to point on a chart that I thought was interesting from your research, which suggests that these sub-Saharan African countries are less dependent on U.S. trade than they are on China trade and even trade with the UAE. So is it fair to say then perhaps the trajectory of growth for China is going to be more important for these countries than the U.S. growth dynamics?
Well, there are two parts to this. One is we know that sub-Saharan African economies have always been very dependent on how the global economy on the whole is performing. The IMF, for example, estimates that if we were to see just a 1 percentage point decline in the combined growth of the US, the UK, Euro area, and China, that alone could be enough to reduce sub-Saharan African growth by 0.3 percentage points and its exports by around 1.4 percentage points in any 1 year. That said, we have seen a considerable decline in the direct dependence on the US as a trading partner. 20 years ago, the US was probably the most important export destination for African exports. Fast forward to where we are now, rising US energy self-sufficiency in particular, and the US has fallen to about 5th place, given the data we've got for 2024. This is after the Euro area, the single largest trading partner, China, India, and the UAE, surprisingly, appearing to surpass the US as an important export destination for sub-Saharan Africa.
Yeah, so fascinating to see the figures. Let me ask you about something else. Are you worried about the state of the relationship between South Africa and the U.S. right now, with President Trump hinting that he may not attend the G20 meeting there later this year? He's obviously been posting a lot about what his perception of the land law is like in South Africa. He is restricting aid. Do you think that this could become a real hot-button issue for not just South Africa economically, but also politically in the coming months?
So there are many different parts to this. The most important, of course, is that in the application of tariffs, sure, the auto sector tariffs are in place, and this has implications for South Africa, which had, up until now, been able to sell a lot of its auto sector exports to the US under the Africa Growth and Opportunity Act, providing it with the opportunity to do this quota-free and duty-free, and that isn't the case anymore. But critical minerals, which South Africa also exports, have been exempt from the tariffs. A lot has been said around the pullback in US aid. It needs to be noted that much of this would have been to NGOs. Given the South African budget, it is an amount that will probably need to be made up somewhere, but it's not an insurmountable hurdle. The bigger issue, as South Africa has said, it remains a neutral player. It is looking to establish relations with all countries. How firm will that relationship be? South Africa, for its part, sees the US as a very important trading partner and a very important partner going forward.
Yeah, very clear. Razia, really good to speak with you today. Razia Khan, Standard Chartered Chief Economist and Africa and the Middle East Research Head as well. Thank you so much for joining us. Now, coming up, Here Why 91 says it seems to be the wrong time to be betting that the Treasury market would absorb any U.S. policy shock seamlessly. More on their market strategy next. This is Bloomberg. U.S. government debt rallied after a Treasury Department official mentioned a potential rule change that could lower trading costs for banks. Joining us is Jason Borbora-Sheen, Income Strategies Portfolio Manager at 91. And of course, that isn't the only driver for the stabilization in bond yields, but there has been somewhat of a stabilization in the last 24 hours. Jason, do you think the worst of this so-called deleveraging or the unwinds that we saw go through in fixed income last week is behind us?
I think in terms of the extent to which yields are being driven by technical factors such as the basis trade that you refer to, that probably largely is over. I think, though, there are some other elements of it which really relate to the behavior of risk assets. So further escalation of the tariff war is likely to create a negative downward spiral for assets like equity, and that does create balance sheet constraints for asset owners that mean they will sell US Treasuries as the most liquid asset. I think there's also a structural question which pertains to the US sort of position, I suppose, in terms of its ability to stand as a reserve currency, as a reserve asset nation, and that could put further structural pressure on Treasury yields.
Do you think that this theme of U.S. exceptionalism has come to a close? Earlier on in the show, we had a guest say, well, it's down but not out. The U.S. ultimately will still rise. So don't ever over-discount the strength of the American consumer. Where do you stand on the market's perception of U.S. exceptionalism right now?
I think you have to split this into a structural and a cyclical outlook. So from a cyclical perspective, I would actually concur with that. I think there's clearly now a lot of pessimism around the ability of the US domestically, certainly, to withstand some of the shocks it appears to be undergoing from the new US administration. But ultimately, yes, I think you have a very strong consumer. You have an income-led cycle, not one based on credit extension. And so it probably can withstand, possibly in a way similar to the way the UK was able to withstand Brexit from a consumption perspective, a lot that's thrown at it. So I think you have to then contextualize that against the structural. And so one of the reasons for US exceptionalism is that reserve status that the US has held. And that means that trade is conducted in dollars. That means that the US has essentially to run a deficit in order to export those dollars to the rest of the world. And the sort of quid pro quo for it is that the US has held a sort of position of exceptionalism. But if you then start to question the reliability and ultimately the consistency of the administration behind that, then US assets and dollar-denominated assets ultimately may undergo a rethinking in terms of whether they deserve that degree of valuation. So if we look at the, I think, financial status of the US, it is a twin deficit country. It does have quite an expensive dollar, and that means that you put those two things at risk from a sort of structural burn if you carry on down a road of inconsistency.
Yeah. Let me ask you about the levels at which 10-year treasuries are trading now, 4.3%. On one hand, you could say that we are accounting for a probability, whether it's 20 or 30 or 40% of a recession in the U.S. with these levels. But equally, is there enough fiscal premium and term premium built in, given what you were just outlining vis-a-vis the U.S., the perception of the world, of the U.S. as the world's, safe haven currency and fixed income instrument has been dented the last few weeks?
Yeah, absolutely. So I think, again, this next question relates really to which dynamics are going to overwhelm or be most important for investors going forward in the Treasury market. If we now see a pronounced slowdown in growth that isn't accompanied by a significant rise in inflation over the medium term, and that's something that we buy into, even if we think that in the shorter run there is space for many assets to stage some form of recovery, given the degree of pessimism in most investors' minds. But if we think that's a sort of medium-term dynamic, then ultimately treasuries can probably move down to below 4% to the high sort of 375 area. They look, we think, cheap to the macro on that basis. If we go across most of our fair value models, there's at least 15 to 20 basis points of value there. But I think on a structural basis, the asset which is most likely to be sensitive to your point on the sort of valuation and fiscal issues is the dollar itself. And the other sort of structural thing we've sort of been talking about for a while is this notion of the EMification of developed markets. And you really clearly saw that last week, in which if you look at all the instances in when the dollar has been weaker, and then look at the change in 10-year treasury yields, you had the highest change in treasury yields for a dollar-weak environment that we've seen in the last 20 years. And that is a sort of traditional emerging market dynamic, not one that you expect from the world's reserve currency.
Yeah, many people were commenting on that in the last couple of weeks, so we've got to see how this all settles. Jason, we'll have to have you back on the show again to discuss more. Jason Borbora-Sheen, Portfolio Manager for Income Strategies at 91. Now, coming up, Dubai's 70% property rally faces a threat from Trump's tariff turmoil. You guessed it. We get the latest next. This is Bloomberg. Bloomberg has learned that billionaire Michael Platt's private investment firm has received full regulatory authorization in Dubai. Blue Crest Capital Management was issued a license from the Dubai Financial Services Authority on Tuesday, allowing it to hire traders to manage capital from the city. The firm already has an office in the Emirates. Dubai's relentless property boom faces its biggest threat since the pandemic as U.S. President Donald Trump's tariffs roil markets and oil prices plunge. For more, we're joined now by Bloomberg Middle East finance reporter Zainab Fatah. So Dubai house prices are up, 70% over the last 4 years. We're now looking at potentially a different environment, lower oil prices, the impact of tariffs. How is this likely to impact Dubai real estate prices?
So you cannot overestimate the importance of oil for this region. It's the main commodity that's exported across the world from the entirety of the Gulf. At a time that Dubai is kind of used as a springboard for mostly the other Gulf economies. So a decline in the oil price because of a trade war between the U.S. and China, if this decline is prolonged, it's meant to have an impact on the government spendings across the Gulf, the amount of money that the Saudi government spent on projects, which mean translation to fewer jobs if there are cuts and massive austerity measures as we've seen in 2014. Some expect that the government might react in a anti-cyclical way and counter-cyclical way to try to help the private sector, but it depends on how deep the oil price cut. Yeah.
But Zainab, can you just clarify for us, are we expecting house prices to drop or to just grow at a slower pace? There's a difference, right?
Absolutely. No one from all the analysts I spoke to is expecting a crash. We're not talking the crash of 2014. We are expecting moderation either in growth, and if this trade war is prolonged, that you could start seeing a decline of 5 to 10%. Now, there are different factors in this region and different factors for Dubai itself, which now is a much bigger economy, a bigger city with a deeper real estate market where people have a skin in the game. They have to put large down payments that range between 20 and 30%, and that means people aren't likely to just let go of properties that are largely mortgaged. They will hold on to them as long as they could.
What's the mood amongst developers that you speak to?
So far, it's been very early, of course, and a lot of developers are telling me for now sales are still going and continuing as usual. But earlier in the year, we've seen signs of some developers becoming cautious. So the chairman of Emaar told me that they're no longer raising their prices. They wanted to ensure that they're not over, as he said, killing the golden goose. So they were building, but they're trying to keep the prices level for a bit because he felt that the increase could become an issue, making Dubai less affordable and attractive to investors.
And final quick point, cheaper USD, surely that's a positive, actually.
Absolutely. For now, this is a positive because it would mean people from China and India and other places can come and invest here. But our currency is pegged to the dollar, and that means if other countries start to devalue their currencies, there is a risk that we could see adverse reaction become at a disadvantage.
Yeah, makes sense. Bloomberg Middle East finance reporter Zainab Fatah, thank you for this story on Dubai's real estate. Always good to round up the program with some Dubai real estate news. All right, that is it for our show, Horizons Middle East and Africa. I'm Joanna Versace in Dubai. Stay with us for Daybreak Europe. Tom will walk you through all of the price action in markets. This is Bloomberg.